Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global. Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely, we have Tony Zhang. He's a Chief Strategist over at OptionsPlay. We're going to get his option strategy focus and macro level view on the markets. Tony, it's great to have you with us as always. And the end of the first quarter of 2020 has come to a close. The worst quarter performance since 2008. Certainly on surreal times that we're living in right now.
Yeah, thank you so much for having me back. This certainly is a very difficult time for most investors. So today we want to talk a little bit about, answering the questions that a lot of people have as far as where do we go forward and how do we look at the data to decide, what directional view we have going forward.
All right. Thank you so much, Tony. And we'll just put up your first slide here real quickly with your disclaimer. Moving along to the second slide with your current market outlook. What are you taking a look at here?
Yeah, so predominantly what we want to try to help investors understand is, the question that we're getting is this a market bottom or is this just a bear market rally that's going to continue selling off? So first of all, I just want to start by saying that a lot of the uncertainty that drove the panic selling we saw over the last few weeks, that's predominantly gone. And what we have is monetary and fiscal policy that has really provided a lot of the relief and provided liquidity in the market. So currently where we stand, I see 235 on the S&P as a pretty strong support right now. I do see that we're going to get a little bit of trouble getting further from where we are right now because on the daily chart, we have the 20-day moving average providing some big resistance. On the hourly chart, the moves that we've had higher have seen some negative divergence on momentum. So I see that we might get a bit of a pullback. So really more of a range-bound market. I think the markets have found a bit of equilibrium here between 235, 273. I do think that there's some chance of the markets continue to move a little lower and retest that 235 level. But again, the uncertainties have been taken out. A lot of the only uncertainties that are left are the economic data in terms of what is the magnitude and duration of the economic impact. And that data is going to trickle in over the next few weeks and months. And I don't really see that causing the same type of panic selling going forward.
All right, let's move along to your third slide here, the stimulus package offset. And, a lot of people have been asked, does this remind you of 2008, 2009? And just by looking at the amount of stimulus that's being injected into the system, I think the obvious answer there is no. This is something very different than the financial crisis.
Exactly. So I think these two charts tell a pretty impactful story of the two opposing forces that are currently working itself out through the markets. You have the $2 trillion stimulus package that greatly exceeds what we had in 2009, and the sheer amount of unemployment that we have just never seen before by orders of magnitude higher, the sheer economic devastation. Now, the good news here is that the government actions have been quick and forcible, which is great to counteract the unprecedented economic devastation that we're currently seeing. So the markets currently are reacting fairly positively to this. And at this point, again, what these two charts tell us is it removes the uncertainty that caused the panic selling. Because during the panic selling, we didn't really know what the governments were going to do. We didn't know the economic impact. Now that we have these two charts, this gives us far more information as far as how we're going to move forward. So by removing uncertainty, this is a net positive for the markets, and that's what we're currently seeing in the markets.
Okay, and I want to take a look at our next slide here. It's COVID-19 trends, what we're actually seeing from the health front and where we are in terms of the curve.
Yeah, so this was the second big uncertainty that we had during the sell-off, that also we now have far more data to give us an understanding. Italy instilled a total lockdown on March 9th. Roughly 18 days later, they've at least, as of right now, we think that they have peaked in terms of the number of new cases and number of new deaths. And we can now take those types of that information and apply it to other countries globally, including here predominantly in New York City, where almost half the cases in the United States lie, where we have a total lockdown, and projecting out roughly, when we can start to see this come to a reduction in number of new cases. So again, bad news is okay. Uncertainty is really what drives the panic selling. So as long as we have bad news and we understand how it's going to be contained, that again is the net positive that we currently see.
Yeah, and I would agree with you there. And if we move along to our next slide here with economic impact, it seems as if we're already starting to model out what this might look like.
Yeah. So this is the last uncertainty that we still have in the markets. And this is really where I see some of the downside risks. And the the problem with trying to model this is that economic numbers typically lag by a few weeks, if not a few months, many times. So what we try to do is we try to look at high frequency data that models what our economy actually, what drives our economy. And if you look at consumer confidence, the US GDP is roughly 70% consumers. So we want to look at consumer spending and consumer confidence and give us a sense for how we're going to be impacted. And, one of the things that Bank of America tracks is high frequency daily data as far as what people are spending their money on. And if we look at this data, there are some surprising and not surprising trends. So at the top of the list, I think what's not surprising is the fact that we've seen travel, entertainment, and restaurants basically fall off a cliff, almost 100% reduction in purchasing in those particular sectors. And those are the sectors that I think are going to have the biggest trouble going into this year and even next year. Clothing, furniture, and department stores, 50 to 60% declines. So this is actually a little higher than I think most people might have expected. And there are some bright spots here. Online, electronics, groceries still holding up quite well, including home improvement, general retail, and health and personal spending, only declining about 10 to 15%. But overall net, we're seeing total card spend down about 31%, which, if you look at where the markets have sold off, that roughly lines up with where the markets currently are standing. So this is the data that we have today. Things might change very drastically a week, a month out, but the data today suggests that I think where the markets currently sit are fairly priced, in my opinion.
All right, Tony, so let's go to our next slide here. And obviously the question is, what's the strategy next? How do I play this? We know the uncertainties are out there. We see it starting to be modeled in. As you mentioned, it's a very fluid situation still, but there are some ways we can work with what we understand right now. What are some positions that you're looking at?
Yeah, so what's amazing is just how quickly markets are changing. I was on last week, and last week we saw significant backwardation of volatility, and for that it was conducive to trading calendars and diagonals. But VIX pulling back below 60, the backwardation, as we've seen a reduction in that, liquidity is improving a little. So the strategies now that we're taking a look at are really bullish credit spreads and bearish credit spreads as volatility normalizes a little and skew comes down a little. These credit spreads start to become a better strategy, and we can focus more so on individual stock picking as opposed to trading the ETFs. So some of the sectors that I'm keeping my eye out on based on some of that credit card data that we just looked at before are consumer electronic stocks like Apple and AMD. Stand out, stocks with strong balance sheets that are likely going to survive this relatively intact in sectors that are relatively strong. These are the bullish types of credit spreads that I'm looking to sell. On the same token, on the flip side, there are some retail stocks that have really performed surprisingly well, like Nike and Lululemon. They're only down about 10, 15% from their all-time highs. That if we look at that credit card spending data shows a bit of a disconnect here. So, and I think some of those strengths will start to fade over the next few weeks. And that's where I'm looking for potentially some bearish opportunities selling credit spreads as well. And then looking out long-term, if we look at some of the utility stocks like T-Mobile and Qualcomm, I think these are stocks that are going to continuously. These are the stocks that I think will have better performance compared to the other utilities that are focused more on the consumer and pricing focus. And I think a lot of consumers are going to be very price sensitive over the next year. So T-Mobile, I think, is a clear winner above the AT&Ts and Verizons. And lastly, energy and travel. This is really based on that credit card data. Until that starts to turn around, until corporate travel starts to pick up a little, I really think that this is an industry that I would stay away from. I see weakness not only in 2020, but well into 2021. So those are the trends that we're currently focusing our attention on in terms of starting to pick individual stocks and individual sectors and focusing our attention on. And lastly, I will just say, be very careful when you're trading options in this particular space, because options liquidity is still nowhere near back to normal. Normally, we see about 400 to 500 names that are in what we consider a liquid category to trade options on. But that list a week ago was about 55 names. We're seeing some improvement now. It's about 130, 140 names as of today. And we do publish this list that you can access at trade.optionsplay.com/liquidity to see what that list looked like. It is improving, but it's still nowhere near normal. So it's important that you choose options or stocks that are very liquid to trade in this particular environment.
That's a great point, and thank you for mentioning that. And let's go along to our last slide here, and I love this because we know, at least in the tri-state area, we are home for the next 30 days, or at least until the end of April. And in that vein, you can get a free 30-day trial because now really is the best time to take advantage of this time we have at home and, understand what you're trading better.
Yeah, so we're offering everyone a free 30-day trial to access not only the research that I presented here today, but also our platform so that you have access to daily options trading ideas, options education, and a 12-step options trading course to help you get started if you're just starting out. And you can sign up just at trade.optionsplay.com/trade talks.
All right, Tony, great to have you with us as always. Thanks so much for joining.
Thank you so much, Jill. Thank you for having me. I hope everyone stays safe and and I hope we all get back to normal soon.
Yes, so do I. Excited to get back on the road. Thanks, Tony. And thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.